So tonight I'm going to talk about what happened in the markets last year. I'm going to talk about what we see in the road ahead in the next year or two. I'm going to talk about some concerns we have when we go into the next recession, and finally some investment fads we think you should avoid. So looking at the market last year, this is the S&P 500, up just almost 22% last year, but that wasn't really the story. It was the way the market went up that was the story, which was with very little volatility. Only 4 times last year did the market drop 1% in a single trading session, and we didn't have a single drop of more than 2%. Typically, you see a drop of that magnitude about every 10 days or so. So very stable markets going up. That all ended after about January 26. You can see we had a bit of a melt up in January, and then we've had some extreme volatility in the market, and we actually had a 10% correction in the market. So we're going to want to talk about that and why that happened. Canadian market's not quite as good. We saw that the market was just the S&P TSX up just over 9%, but all of that came after September 8th. And again, we have that sharp fall off in the market. It looks worse than the US market, but actually it's not as bad. The market's only come off about 7%, but again, we have that volatility. Now, even though the Canadian market didn't do as well, doesn't mean the Canadian economy didn't do as well. And in fact, if we look at the bond market, the Canadian economy actually performed well, and we can see this in the yield curve. So the green line is the yield curve in Canada at the beginning of the year. And as you can see, it's upward sloping from 2 years to 10 years, and that's a normal yield curve. We'd expect to get a higher yield the further out we go. If we're locking our money up for a longer period, we should get a higher return. However, you can see by the end of the year, that yield curve had flattened. Short rates had gone up almost 1%, but long rates only about 32 basis points. That flattening is something that we saw even more in the US yield curve. Again, you can see the US yield curve, how it started off the year, but look by the end of the year. The short end, the 2-year, only up about 70 basis points, but the 10-year barely moved. In fact, it went down a little bit. If the economy is getting stronger, and if the central banks, the Federal Reserve, is increasing short-term rates, why are 10-year yields not going up? Typically, 10-year yields are more influenced by what's happening with the market, whereas the short end is what's happening with monetary policy. And the reason is because people were concerned about inflation or a lack of inflation. We didn't see very much inflation in the economy. But we saw, and you can see I'm putting on the yield curve where it was in around the middle of March. You can see how yields had moved up. Now, the yield curve is still very flat, but it has moved higher. And the reason is because we started to see some inflation at the beginning of this year, and that's why we saw the volatility in the stock market. So it begs the question, looking forward, is this a sign of a coming end of the business cycle, a recession, a bear market, or is it a buying opportunity? And so we're going to want to talk about that.